Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over Twitter again. Got a lot of good information here. Tavi's got a blowout of a thread that I'd like to cover and discuss. It falls in line with I'll say my opinions, my paradigm of what's coming over the next decade. A little bit higher inflation rate, higher interest rates, and the market conditions that are conducive for a commodity bull market. We also have underinvestment in commodities, so everything is still the same. And I'll go over a couple of other things as well. We've got a little bit of mortgage rates, interest rates, stuff like that we'll cover, and some other things that are stock market and commodity market related. If you guys need any help with anything, check out finding-value.com. You can sign up for the Platinum membership, use the word discount in the coupon code, get yourself a discount. And we also have a Sunday Platinum question and answer session at 5 p.m. Mountain Standard Time if you'd like to join that question and answer session. Let's dive in here. I'll give you my financial opinions. And again, if you want to follow me, it's at finding_finance. So it says, having traded in both the 2000, 2002, and 08 and 09 bear markets, the biggest drops occurred after the Fed pivot. So I know a lot of people say, oh, just wait for the Fed to pivot. Just wait, just wait. The interest rates go up when things are good, when things are inflationary, when things are heated up. When things become less heated and they actually start to deteriorate, where you can get a financial crash, that's when interest rates go down. So a lot of people have it backwards. So think of it as the heating up portion, and then the Fed pivots, and that's where you get the decline. The Fed pivots because of the deterioration in the inflation rate, in the drivers of the market that's driving the things to be good. So this is just showing us that we've got a deterioration in the markets when the rate goes down or when the Fed pivots. That is something I wanted to cover. Here's one. This is Josh. Says, for those who've been asking me about another interpretation of global inventories from a particular European analytics firm, there's a guy who said that we have a lot of inventory in oil. That is inconsistent with the S&P Platts, Vortexa, Kepler, Genscape, and Andurand weighs in. Be careful with modeled versus actual. Pierre says, a big part of the data is modeled, so to be taken with a pinch of salt. For example, OilX models Chinese product stocks and have them at very high levels and with strong builds last year. I personally think they are low and are drawing pretty fast. There is a debate going on between oil inventories, between these different firms. One of the groups had released that there was a lot of oil inventory worldwide, and that is inconsistent with everyone else in terms of inventories. So there is that going on in the background, just an FYI. Here's commodity prices changes over the last year. Sugar up, CPI up, heating oil down, gold down, all the way down to the bottom here. The ones that I think that have good upside are the ones down at the bottom here. Natural gas, crude oil. There's some good opportunities down here, and I think to be a contrarian is probably a good thing. What you want to do as an investor is you want to look what's low. Generally, you can chart this on a ratio perspective. Natural gas is cheap to like everything right now. So is platinum. And you look at those and you want to wait for them to bottom and start to turn and increase into strength. So that strength is what we want to buy into. We want to get into strength. We don't want to. So you want to buy into the strength and not necessarily buy into weakness. So you always want to make sure that these things are strengthening, although they're cheap and they've gone down, instead of buying into weakness and trying to catch a falling knife. We've got, with a swing low and close above the 10-day moving average, Nat Gas finally prints a DCL. Trying to think of what that would be. Expect some back testing before a move higher. I completely agree with that. Ideally, we would see a very flat daily cycle here with a double bottom. That double bottom is that squiggle I always write, that comes down like that. That's usually what we see. And a lot of the times we can see bottoming patterns like an inverted head and shoulders, where you get a shoulder, head, and then maybe another shoulder, a double bottom, which is that W bottom that we always talk about, or something that squeezes up. And I don't think we'll get the squeeze up pattern. But this is a commodity that I'm really focusing on is natural gas over the next year, 6 months, year. And it will bottom out at some point here. Here's another one I want to go over. It's there's nothing new on Wall Street. Jesse Livermore, 1923, referring to Marty, I don't know how to pronounce his last name, 17 Rules of Investing from 1990. And there is one I do disagree with. So it says, the trend is your friend, don't fight the tape. And that's what we want to look for, changing trends. We want to see a downtrend that's broken, putting in a bottoming pattern or process of putting in a bottoming pattern, and then buying into that strength where your trend is your friend. That is how you tie it together with the stuff that we do on the website. We look for bottoming patterns. We look for things that are squeezing up. We look for the dead periods. These are all kind of things that I have coined as sayings. And then we look for, hopefully, a new trend that is developing. And then AKA your trend is the friend after that. Let profits run, take losses quickly. That's what I talk about, buying into strength and loading into something that is working versus something that is losing. Very similar idea here. If you buy for a reason and that reason is discontinued or is no longer valid, then sell. If the values don't make sense, then don't participate. The cheap get cheaper and the dear get dearer. Don't fight the Fed, less valid than point number one. What I would suggest is this is actually a wrong saying there. The Fed the Fed just reacts to the markets, and the Fed's going to raise interest rates into a strengthening market, and then they generally lower their interest rates in a weakening market. So the thing you actually want to do technically is you want to fight the Fed and you want to do opposite of what they do. So you want to buy inflation assets when they're fighting inflation, and you want to sell inflation assets when they think that the inflation is gone and they're going to lower that interest rate. So I don't know what that means. I don't know if it means you're really fighting the Fed. I would think that you are. You're doing opposite of what the Fed is. You're going to buy assets that are inflationary during an inflationary period with an increasing interest rate environment. Then you ditch them when they turn and swap and start lowering those interest rates because a crash could come. Now, it doesn't mean that that commodity will necessarily blow out, but a lot of the times it does. I will say that. Every indicator eventually bites the dust. Adapt to change. Don't let your opinion of what should happen bias your trading strategy. Don't blame your mistakes on the market. Don't play all the time. The market is not efficient, but is still tough to beat. You'll never know all the answers. If you can't sleep at night, reduce your positions or get out. Don't put too much faith in the experts. I like that one. Don't focus too much on short-term information flows. Beware new era thinking. It's different this time because. And I agree with the majority of these, and that's why I wanted to share it. The ones that I really like are don't put too much faith in experts. Don't focus too much on short-term information flows. Basically news. You want to look for the structural market condition changes, and that's what we look for in the market conditions and ratios. It's a non-biased way to be objective. This is the average 30-year mortgage rate in the U.S. You can look at it from this chart here. You can see where we're at in relationship to history. We're back to where we were in the mid-2000s. So that's where we are in terms of mortgage rate areas. And we've gone up massively. Look at this rise here from 2021 all the way up to 2022 and onward. Big increase in mortgage rates. Now it says, so if this rocket is to explain this chart, the courts look down upon that too. This is the federal government current expenditures in interest payments. Look at this thing rise, guys. This is going vertical in interest payments. I showed you the mortgage rates, which is also tied to the interest rates of the 10-year yield and 30-year yield and short-term interest rates. But that has an impact on your interest payments for the government. And you can see the impact that it's having. We went from 600 billion heading straight towards $1 trillion in interest payments soon. We've got two scenarios for natural gas. If we're back in 2001, greater years ahead. If we're back in 2009, lesser years ahead. What are you betting on? And this year we've pulled on back. Was this abyss of the recession? No, it's not. It's not a recession abyss. It's from weather. And that weather has brought this back, in my opinion. I think that we are in 2001, and I think that we could pull up much higher over the years. But that's my take on it for natural gas. Oh, and this is the natural gas versus the producer price index. I forgot to label that. And you can see the producer price index. You can see here that it's pulled back a little bit, and it's just kind of moving sideways. I do think that will work its way on higher to some extent. Maybe not immediately. We could maybe see it dive down a little bit, but over time, we could see that. Thought of the day, what's our favorite commodity? One that is trading below the cost curve with little inventories. Muted supply response possible and related equities trading at less than 1 times free or 1 times cash flow within 3 years out. The ones that pop to my mind right now are natural gas, platinum, energy service companies, some of those, and Baltic Dry Index. And I've got a bunch of companies that actually meet or are very close to this criteria, where things are trading at less than 2 times, 3 times cash flow, which I consider to be cheap, especially if the average long-term average is more like 4, 5, 6, 7, 8 times cash flow. So this is the monster thread that I really liked. He says, financial conditions are too loose for inflation, but too tight for financial assets near record valuations. If this is the beginning of another decade of higher than average cost of capital, equity markets are yet to reflect these changes in fundamental multiples. So if we look back, it says since 1900, there has been only 5 decades that the total return for stocks was negative. In fact, deeply negative. 3 of these periods happened during inflationary areas. So 5 decades, 3 of them happened in inflationary areas. The other 2 occurred when equity valuations were at historical levels. Today, we have both issues at once. We've got historical valuations of equity valuations, and we've got an inflationary era. This is also why I'm an ultra bull in commodities, because this money is going to rotate over. It says U.S. stocks worst returns by decade, 1910s, 1930s, 40s, 70s, and 2000s. These are all inflationary decades. The 40s was inflationary, 70s was inflationary, 30s was not. 30s, but you could argue that it was because they revalued gold 50% in 1930s. They revalued it and commodities went higher. This was a commodity boom in 1930s. So we had commodity booms in each and every single one of these eras. We're going to have another commodity boom here. We also have a high CAPE ratio. CAPE ratio is the PE ratio, price to earnings ratio of stocks, which means they are incredibly overvalued. It says investors have been conditioned to value financial assets as if they were about to experience another disinflationary decade. As shown in the last chart, the last time we had a long period of higher than average cost of capital was in the 1910s, 40s, and 70s. So he's talking about interest rates is the higher cost of capital. And you can see the decline in every single one of those periods of the equities and the multiple compression during those timeframes of an average decline of 47%. So that's a commodity boom with higher interest rates and more inflation. We saw average declines of 47% in stocks during that decade. And you can see that they do fluctuate over that time frame. They didn't go straight lower. It says, while each had its own unique circumstances, fundamental multiples for stocks significantly contracted over those decades. To be specific, the average decline was nearly 50%. More importantly, note the CAPE ratio, which is the PE ratio. We're at single digits at the end of the 2 periods and around 10.5 for the 40s. What if today's multiples were to reach similar levels by the end of this decade? It says, let's do an exercise with different assumptions. The last decade, the 2010s, marked one of the best times for corporate profit growth in the last century. By the end of that period, 10-year cyclically adjusted earnings had grown by 61%. If we were to experience the same robust increase this time around, assuming a 10.5 CAPE ratio, the S&P 500 would be trading 55% lower by the end of this decade. While this may sound extreme to some, What if we use a 15x CAPE instead? That would take the S&P 500 about 34% lower than its current prices. Okay, what if we apply the corporate earnings growth rate that occurred during inflationary decades instead, using Professor Schiller's data? From the beginning to the end of these periods, the average increase in the 10-year cyclically adjusted earnings was close to 16%. In that case, assuming a 10.5 CAPE ratio, again, US stocks would be down approximately 67%. Alternatively, using a 15x multiple, equity markets could be down as much as 52%, so somewhere in this range. While these declines may seem excessive, they are simply a function of historic multiples in a high cost of capital environment like we have today. Today's multiples are over 70% more expensive than they were when each of those inflationary decades began. And what's driving that down is your risk-free return on bonds, that interest rate. And the net present value calculations are going to price these assets lower, these stocks. So it says US stock valuations at the beginning of the prior inflationary decades. This was at the beginning. So at the beginning was 14.5, 16, 17, and we're at 29. We can get absolutely decimated to the downside if we enter a highly inflationary environment where the cost of capital or interest rates really start to take off. So it's very dangerous to be in stocks, in my opinion, because of the risk reward. And that is not supposed to be meant as advice or anything like that. I'm just saying the risk reward here is actually far worse to the risk side, downside, than in these previous beginnings of those commodity bull markets. It says, to be clear, these scenarios didn't consider the potential impact of a contraction in earnings per share. What if the pressure from rising labor costs becomes structural? Margins compress from record levels, while most analysts on Wall Street expect profits to grow at double digits in 2 years. Nominal corporate earnings have been trending in an upward channel for 70 years. Every time profits reached the upper band of this range, an earnings recession followed. We are at a similar peak level juncture again today, while analysts continue to be overly optimistic. So he's basically saying when we hit this upper trend line, we've always had a pullback in nominal earnings. Pullback, 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 pullback. And we're hitting that line right now. We could see a pullback in nominal earnings. And with the structural wage increases potential, we could see this pullback quite dramatically. So not only are we at a 29 to not only are we at 29 price to earnings ratio, what he's saying is that our earnings could also drop at the same time. So we could see a massive pullback in the S&P 500 if we hit a high cost of capital or a high interest rate environment, including lowering earnings as well. So you're going to get a double hit where the S&P could really start to contract and move a lot lower. So it says now, when adjusting these numbers for inflation levels, the current real growth in corporate earnings for this decade is on pace to be the second largest in history. That is right behind the prior decade's performance. So the 2010s, you can see how high we went from the normalized growth here and how this could really reverse to the downside. This is 2020s here, and I think he's probably thinking that this is going to head lower. It says outside of the 2010s, the other two times we had outstanding long-term increases in profits were 1920s and the 1990s. Both periods preceded severe earnings recessions. So the 20s and the 90s both had gigantic pullbacks in the 2000s, which preceded 1990s, and the 1930s, which also had a massive pullback from the 1920s. So the 2010s, we're most likely going to see a gigantic pullback in the 2020s decade for earnings. So it says our work shows that corporate margins are likely to be drastically reduced by a combination of these key macro forces. An early stage wage price spiral, higher costs of capital, rising deglobalization trends, a continuation of structurally rising material costs. I completely agree with every single one of these. It says, however, despite the risk of cyclical downturn in profits, it is important to point out that, even in real terms, corporate earnings increased on average by 13% during inflationary decades. More notably, these periods were extremely volatile for profits. There's the volatility during those three other eras. It says the issue today is that we are 2 years into a decade and corporate earnings have already grown by 23% with companies at their highest profit margins in history. That is the lagged product of unprecedented monetary stimulus that has been reversed. The broad stock market outside of natural resource industries is historically expensive on almost all fundamental metrics. It's one of the main reasons why the start of the decade is so unique, especially compared to the 1970s when equities were substantially cheaper. On a CAPE ratio basis, for instance, market prices are near record levels relative to 1, 3, 5, and 10-year cyclically adjusted earnings. So this is your earnings adjusted. And these are the percentiles. So this is the adjusted PE ratio, historical percentile. We're way up at whatever you want to use, the 10-year, 5-year, 3-year, or PE. We are way up there at a very high valuation of those different valuation metrics. So we are very expensive. It says the only plausible way to justify the current multiples in equity markets would be if, for the first time in history, we were to experience a 50% increase in real earnings for back-to-back decades. However, every prior speculative environment like we have today ended with significant real earnings and economic contraction. With the monetary liquidity that drove this mania having been sharply reversed, it is hard to make a compelling case why this time will be different. Valuations for the top 10 mega cap tech stocks are still higher than they were for their comps at the peak of the tech bubble. This is the peak of the tech bubble. This is their current 2021 top 10 mega cap tech stocks. We could see this valuation vastly go down to match other historical decades of valuations during these types of market conditions. It says earnings yields for US stocks is now close to turning negative versus the Fed funds rate for the first time since the tech bust. So this is US tech, this is Russell 1000 current earnings yields starting to roll over at the same time that the federal funds target rate is heading on higher. So this is going to get real interesting here, guys. And I do think we'll see a large decline in these types of companies, Russell 1000, S&P 500, and whatnot. It says, yes, equity risk premium were also below zero during most of the 90s, although those years were accompanied by very strong growth led by new technologies and the internet. It's hard to believe that we'll be entering another decade of above average growth for one of the strongest bull market periods in history. Corporate bonds look even more concerning. The average bond already yields less than the Fed funds rate and is now at its lowest spread in 30 years. You can see this guy heading on lower to the downside for US corporate bonds minus the Fed funds rate. And we haven't even seen that all the way back to the 90s. It says, why would anyone take the extra risk of owning these instruments when one can receive over 4.5% yield risk-free? This is arguably the most expensive part of today's market. On the other hand, the Fed is playing with fire. Despite the recent rate hikes, financial conditions remain way too loose. This is typical of an early inflationary cycle. The longer inflationary forces persist, the harder it will be to expel them from the system. This is the Taylor rule to Fed funds rate spread. And we can see that we are way up there between that spread of history, which means if this stays longer, if they don't tighten it even more, we could have an inflationary problem. It's going to stick around even longer. It says the increase in the cost of living has exacerbated the already severe wealth gap issues in society, unleashing what is likely to be the early stages of a wage price spiral. So that is a great, I'm going to end on that. That's a great topic there. He's got a lot of really good things. And basically what he's saying is stocks and technology stocks, the way that they're priced today, they're going to go down given the market conditions that we have out there in terms of interest rates and inflation. So I think we are going to see that roll over and head lower. During these decades, commodities, especially energy, do very well because that's one of the most inflation-sensitive assets. And that performed incredibly well in the 1970s. I do think it's going to perform incredibly well going forward. I've got a lot of ideas around that. If you want to sign up for the finding-value.com and how to play this commodity bull market that is coming. It's going to be volatile. It's going to be up and down and all around. But overall, I think that we're going to trend higher lows, higher highs. But that's what I've got for today, guys. Hopefully you enjoyed the content. Give me a thumbs up. Subscribe to the channel if you haven't already. And we'll catch you next time. This is Finding Value.